VONG's 114% crushed VTI's 78% over 3 years. But here's the catch. That outperformance came with a serious price tag. Growth stocks sound exciting until you see this. VONG crashed 8 points harder than VTI. That's the price of chasing upside. But here's where it gets interesting. VONG crushed it with a 114% return over 3 years. That's nearly double what the market delivered in that time frame. Let's see you zoom in on this. VTI's 78% 3-year return is solid, but it's clearly outpaced by growth funds during this bull market run. In plain English, think of these funds as race cars competing over 3 laps. VONG absolutely dominated, crossing the finish line 36 points ahead and leaving VTI eating dust in this 3-year sprint. Here's where the story takes a turn. VONG's 102% 5-year return is solid, but the warning's clear. That early dominance is starting to fade away. Let's break this down further. VTI's 84% 5-year return nearly closes the gap, just 18 points behind when you zoom out on the timeline. But here's where it gets interesting. Both funds delivered identical 18% returns this year. VONG's growth edge completely disappeared when markets got choppy. In plain English, here's the marathon analogy in action. VONG sprints ahead early with massive gains, but that lead doesn't last. Over a full year, both runners cross the finish line together in a tie. Let's dig into the details. VONG's 1.2 Sharpe ratio means you're getting solid returns without taking on excessive risk. Pretty efficient performance over 3 years. Here's where things get revealing. VTI's 1.1 Sharpe ratio shows you're getting solid risk-adjusted returns. Less drama, but still delivering efficient performance for your money. Now let's put this in perspective. Over 5 years, both funds delivered identical 0.6 Sharpe ratios. VONG's growth edge completely vanished when you adjust for risk. In plain English, here's the thing about risk-adjusted returns. It's like getting a report card where extra credit doesn't count. VONG's higher returns came from taking more risk, so both funds end up with nearly identical grades. Here's the thing though. VONG's 1.7 Sortino ratio means it's delivering strong returns while keeping downside risk in check. That's the sweet spot you're looking for. Let's take a closer look. VTI's Sortino ratio of 1.5 shows it's slightly less efficient at protecting you from those painful downside moves during market drops. Now here's where it gets tricky. VONG's 33% maximum drawdown shows you'd have watched a third of your money vanish at the worst moment. But that's not the whole picture. VTI's worst crash was just 25%. That's 8 percentage points less pain than competitors when everything hits the fan. In plain English, VONG's deeper 33-foot dive versus VTI's 25 feet might not sound dramatic, but when your portfolio is drowning in a crash, those extra 8 feet of pain can be the difference between surviving and panicking out. Here's what really matters. Waiting over a year just to break even? That's 439 days of watching paint dry while your money goes nowhere. Now let's connect the dots. VTI's 433-day recovery shows broad market investing doesn't save you from long, painful waits after major crashes either. In plain English, both funds took over a year to bounce back from their crashes. Think of it like a building crumbling and rebuilding. There's no quick fix when your investment collapses that hard. Let's unpack this a bit. So which one wins this battle? VONG or VTI? Make your prediction now. Here's the key takeaway. VONG's 19% volatility means steadier performance. You'll avoid the wild swings that can wreck your portfolio overnight. Now let's flip the script. VTI's 15% volatility means smoother rides. 4 percentage points less chaos translates to fewer sleepless nights watching your portfolio swing wildly. In plain English, here's the roller coaster reality. VONG swings harder with bigger drops and sharper turns, while VTI gives you that smoother, steadier ride. Choose your thrill level wisely. Let's get into the weeds here. VONG's 1.2 beta means it'll amplify market swings by 20%. Bigger gains in bull markets, steeper drops in downturns. Now let's shift gears and look at VTI's 1.0 beta means it mirrors the market perfectly. When the market moves, VTI moves exactly the same way. In plain English, think of beta like an amplifier knob. VTI's at 1.0, playing market moves at normal volume. VONG's cranked to 1.2, so every market swing gets amplified louder in your portfolio. Let's zoom in on this. At just 0.07% annually, VONG's fees are incredibly low. You're only paying $70 per 100,000 invested each year. VTI's rock bottom cost means you're keeping more of your returns. Just $30 yearly on a $100,000 investment. Here's where the story takes a turn. That 4 basis point gap sounds tiny now, but it snowballs into thousands over 30 years. VTI's advantage compounds silently. In plain English, think of expense ratios as couch change slipping away each year. VONG charges a bit more than VTI, and over decades, that difference quietly compounds into real money you'll never see again. Here's where things get revealing. At 14% turnover, VONG barely touches its portfolio. It's a buy and hold fund, not a trading machine. Now for the real question. VTI's 2% turnover means it barely trades at all, keeping your transaction costs low and Uncle Sam's cut minimal. In plain English, turnover's like dance partners at a party. VTI keeps the same partner all night, while VONG's constantly swapping, creating more movement, more action, and more costs along the way. Here's where things get revealing. VONG holds 394 stocks, concentrated enough that individual winners can really move the needle, but diversified enough to manage risks smartly. Now let's put this in perspective. VTI holds over 3,400 stocks. That's 9 times more diversification than VONG gives you. Massive difference in breadth here. But wait, there's more to this story. VONG crushed VTI with a 36-point lead over 3 years. But that power came at a price, a brutal 33% crash. When you adjust for risk, though, they're basically neck and neck. Here's the thing, though. VONG's 394 holdings versus VTI's 3,000 plus shows you're concentrating risk versus spreading it across everything. In plain English, fewer eggs, bigger risk. VONG's 394 holdings mean each stock carries more weight. One collapse hurts more. VTI's 3,484 holdings cushion the blow when companies stumble. Now here's where it gets tricky. VONG puts almost 2/3 of your money into mega-cap stocks. So that's heavy concentration in the market's biggest players. But that's not the whole picture. VTI keeps just 40% in mega-caps, spreading the rest across mid and small companies for better balance across the market. Let's see how this plays out. VONG packs 64% into mega-caps versus VTI's 40%. That's betting heavily on today's giants staying tomorrow's winners. In plain English, here's the concentration difference. VONG loads up on mega-caps with 64% in the biggest companies, while VTI diversifies broadly. It's like betting heavily on a few giants versus spreading your risk everywhere. Now let's connect the dots. VONG's got a major concentration risk here. 51% in tech means half your bets riding on one sector's performance. But hold on a second. VTI keeps tech at 33%, still a major player, but you're getting way better sector diversification than pure tech funds. Let's unpack this a bit. VONG loads up 51% in tech versus VTI's 33%. That extra concentration means you're taking bigger hits when tech tanks. In plain English, here's the pizza slice breakdown. VONG loads up half your portfolio with tech, like ordering a pizza that's mostly pepperoni. VTI spreads investments across sectors, giving you way more variety on your plate. Now let's flip the script. VONG's 114% three-year return proves growth investing pays off. Mega-cap tech bets absolutely demolish the broader market during this period. But there's a catch. VONG's 33% drawdown shows concentration's dark side. When your focused bets fail, you're feeling every bit of that pain. Let's get into the weeds here. VTI's broad diversification delivered a smoother ride. 78% gains with just a 25% drawdown. Less drama, more stability for your portfolio. In plain English, think of it like seesaw physics. VONG tips hard toward growth and risk, while VTI stays balanced in the middle. Neither's wrong, just different investing philosophies at work. But here's where it gets interesting. That 4-point volatility gap means VONG swings much harder during downturns. Expect bigger drops when markets crash. Let's just zoom in on this. Over 430 days to recover from losses? That's more than a year watching your money climb back, painfully slow for both funds. In plain English, think of it like marathon runners with serious injuries. Both need over a year to heal, so you're not getting back to racing anytime soon after a major crash. Here's where the story takes a turn. That 0.04% difference saves you $40 per 100,000 invested. Compounding to thousands, you'll actually keep over 30 years. Let's break this down further. VTI's 2% turnover means you're keeping more gains. VONG's 14% turnover chips away at returns through taxable events year after year. In plain English, here's the report card on hidden costs. VONG's bucket leaks a bit more through fees and taxes. It's like running a race with slightly heavier shoes. You'll still finish, just not quite as fast. Now for the real question. VONG delivered stronger returns at 102%, but you're paying for it with 33% drawdowns and heavy mega-cap concentration risk. Let's dig into the details. Both funds delivered identical 18% returns over the past year. Growth's supposed edge completely disappeared when you zoom in recently. In plain English, VONG's got the flash and excitement, but VTI wins the marathon with rock-solid consistency. It's like choosing between the star athlete who peaks occasionally versus the reliable A student who delivers every semester. Now let's put this in perspective. VONG's gamble, 36% extra returns versus 33% crashes and 19% volatility. Your risk tolerance decides if it's worth it. But wait, there's more to this story. VTI's 84% 5-year return with lower volatility, cheaper fees, and broader diversification. Boring wins when you want peaceful sleep. In plain English, think of it like race cars. VONG's the high-octane speedster that'll burn more fuel and crash harder. VTI's your reliable daily driver, getting you to the finish line without drama. Let's take a closer look. VONG suits aggressive long-term investors comfortable with major drops, while VTI offers smoother, diversified growth for moderate risk appetites. In plain English, think of it like racing athletes. VONG's a sprinter built for explosive speed and maximum performance, while VTI's your marathoner prioritizing steady endurance and consistency over decades. But that's not the whole picture. Standard legal stuff here. Do your research, talk to professionals, invest responsibly. Let's see how this plays out. Want more ETF comparisons? Subscribe now for weekly battles where we break down which funds truly deserve your investment dollars.